mortgages are one of the biggest mistakes you can get yourself into if you're planning on using it for investment purposes. So if you're planning on buying property and planning on funding it with a mortgage, it definitely does not make sense in 2026. So we're going to take a look at the Scotiabank mortgage calculator here to figure out why these mortgages don't make much sense. And the first reason here is the risk you have when you get into a mortgage upfront, okay? So from year 0 to year 5, you're essentially upfronting the interest while paying off very little principal. So the banks are winning right off the bat because you're paying a huge amount of interest in the year. And as you know, it amortizes as the schedule goes on, then you get to pay off more and more principal. Okay, so it only really makes sense at about year 15, where now you're paying 50% for interest and 50% for principal. All right, but in the beginning, it's mostly just interest, and I'm gonna show you how that looks like so you can visually see what I mean here. The second thing that's important is this interest rate. So 5.25% in interest on a mortgage of 300,000 is insane. The reason why is 5.25% is actually a good return on the stock market. Like, you're not going to be super upset if you got a 5.25% return in stocks that you invested in the year. But here, the bank is able to get 5.25% on the set 300,000 while having collateral, which means if you default on your mortgage, they take your home. All right, so their risk is very minimal because even if you fail to pay off that mortgage, they'll still take your home. And in a good economy, the home is going to be worth more. Okay, so over time, real estate appreciates. So they're going to get a mortgage, they're going to get something that's actually in value, and they're going to sell it for even more. While you lose that option and you lose, the ability to pay while you're paying this 5.25% interest, which is just absurd. Okay, so this is an unbelievable amount that you have to pay right off the bat. And then obviously the second thing here was the risk that you have. So how this gets split between interest and principal. The problem here is you can't really tell. When you look at 1788 monthly, you're thinking, okay, that's not too bad, right? I can do it. It's not too much. I get a home out of it. But if you were to look at the actual amortization schedule, you would see that doesn't make a lot of sense. Okay, and here on Scotiabank's website, they don't even give you an option to see how this amortizes. Okay, so on the RBC website, they do, which is very good. And you can see here they even have a little bit of a better rate. And this is the mortgage detail that I inputted. So you have a mortgage of $250,000 with interest rate of 4.59, still high, but much better than 5.25. Amortizing at 30 years, which, by the way, most banks now do that. After COVID, they're essentially putting their amortization schedule to be much higher than that standard 25 years. Now 30 years is like the baseline. And it's obviously not good because you want to pay it off faster. You don't want to pay it off slower. But because of the stringent rules with loaning in Canada, it's very difficult to get a mortgage. They only give you very little. You need to have a longer amortization, which again is working against you. You want the amortization to be as little as possible so you can pay it off as quick as possible. But they won't lend you an amount because they'll say it's too risky. However, this 30-year amortization schedule, when you visually look at how much you're paying, okay, through a amortization table or graph, you're going to see that pretty much in the first 5 years, you've paid off nothing. You've literally paid off very little in this graph. And then the only time you actually start making headway is from year 15 to year 30. And that amortization table, and this is going to infuriate you if you have a mortgage, is that you have so much risk from year 1 to year 5 without much return. So if we look at the principal amount of $250,000, you pay in total in the year $15,284, of which $11,284 is interest and only $4,000 is principal. Okay, so now if you were to sell the home, you owe the bank $246,000, right? But you've paid $15,000 in total in the year. Do you see? There's this disconnect here where you're just like, okay, how could I pay 15,000 in the year and only pay 4,000 in principal? Like, make it make sense. And that's the thing is, I understand why it makes sense. I understand this is how they set it up. This is how the bank set it up. This is how the amortization schedule works. But it's just not fair for you as an individual. Why would I have to pay 15,000 and only get 4,000 of principal? And by the way, this grows little. So in year 2, it's 4,100. Year 3, 4,300, 4,500, 4,800. Like, these are very little minimal amounts. Your mortgage is still 228,000 at the end of year 5. So 228 from 250. That is not a big amount, okay? So when you go through this, you can see that it only really makes sense from year 15. That's when it's 50-50. So about 50% is paid as mortgage and as interest, and 50% is principal. And then it kind of just goes down to all principal. But, instead of, making it so it's all principal first or whatever, or making it just 50-50, you're upfronting the interest right away for a financial tool that banks literally don't have much risk over in a good economy, and you're essentially losing for it. And you're paying lots of money. So if we look at how much you have actually paid, so 15,284 times that by 5, you're paying 76,000 in total payments, right? But the amount that you've actually paid is 22,000. So 76,000 in payments with 22,000 only paid off. So, I mean, it just is what it is, I guess. That's just, this is the reason why you shouldn't get into a mortgage to begin with. It's not a practical tool for investment purposes. And if we look at the risk that you take as an individual, if you're using it as a financial investment, you have to deal with renters. You have to deal with people, the risk of them not paying, with the risk of them not paying and not being able to kick them out. All kinds of risk with the home leaking, any types of problems that you have to fix, property tax, all these taxes, as well as insurance. Everything builds up, and you're just not getting anything out of it until later down the amortization schedule. So you can see that this is not the best tool for you. Even if you live in a home just to live in, you're still putting up a lot of risk, okay? Because, the home, you will have out-of-pocket costs if anything goes wrong. Now, if you're wondering, this could still be a good tool if price of homes continue to appreciate at the rate that they were appreciating, okay? So in Canada, homes, they flew up in price. So like a mortgage, it didn't matter if you got into it. It was just about getting into the investment. Now, if we take a look at how the cost of a home is, so the average cost of a home in Canada was 694,000, and you can just see it slowly going down. Slowly, it's just getting less and less and less. If you look at it through a 3-year perspective, you're going to find it peaked in 2023 and then just slowly continued going down. So in your mortgage, if you got a mortgage in 2023, you essentially got the worst luck because you paid the highest amount, got the highest mortgage, and you're not even paying off the mortgage while your home is depreciating. But if we look at it on a 10-year scale, you can see that the price of the homes skyrocketed. So if you got it into a mortgage at this time, you would see it flew up, and now it's just consistently going down. And the reason why I'm sharing this is just to show you how impractical the mortgage is. Or a mortgage. So don't fall into the mortgage trap if you're thinking about getting an investment just to invest in real estate. There are things to consider. I would say at least consider the idea of what risk you have and why the mortgages don't really make much sense. So if you are, planning on getting a mortgage, obviously make sure that interest rate is the lowest and try to get the amortization schedule to be as low as possible for how much they end up loaning you. Knowing that it's April right now, 2026, end of April, and you have the tax filing coming up, I do recommend using Wealthsimple Tax for your tax filing for 2025. Click the link in the description and you get $25 if you fund your account with $100. So that's really great. You get 25%, and it's absolutely free, the tax filing. It's by donation. You can give $0 as a donation, and it'll be free. And you can make $25 out of it if you click the link in the description. If this video helped, make sure to hit the like and subscribe button for more practical Canadian tax guidance videos as well. Remember, this is just general information, not personalized financial or tax advice.